all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome back to The Long-Term Investor. This week, I'm joined by my friend John Owens, who is the managing partner at Brooklyn FI, and we are going to break down year-end planning for people with equity compensation. Now, this can sometimes be a tricky topic because there are so many different types of equity compensation and so many different nuances to the complex tax planning involved with those different forms of equity compensation. And so we try to keep it high level while digging in piece by piece. So hang with us as we get through RSUs, stock options, ESPPs. We talk about how to unwind concentrated stock positions, how to use 10b5-1 plans, and even walk through some charitable strategies to help you improve your outcomes. So if you've ever wondered what to prioritize prior to December 31st, this conversation gives you concrete order of operations. And if you want some help navigating your equity compensation, or maybe even diversifying your company's stock position in a tax-efficient manner, you can schedule a call with me by visiting callwithpeter.com to learn more about becoming a PlanCorp client. And now, here is my conversation with John Owens. Welcome to The Long-Term Investor. Today, I'm excited to have my friend John Owens, managing partner of Brooklyn FI. John, thanks so much for joining the show.
Peter, thanks for having me. Glad to be on The Long-Term Investor.
Well, we were speaking, I think it was a few weeks ago over dinner, and we're talking about year-end tax planning. And listeners of the show know that, sometimes I can talk about taxes like I'm in a play. I hear the terms a lot. I sort of know the rules, but my real expertise comes on the investment realm. And your firm in particular focuses so much on RSUs, on options, on ESPPs. And I thought it would be good to dive in. But before we do, I want to let the audience recognize how hard a task this can be, where there's so many different types of equity compensation, and we could go down deep rabbit holes on all of them. So we're going to attempt, after speaking to John over a long, lovely dinner, I realized I think he's our guy, where we can touch on a lot of the important issues. And I thought maybe, John, a good way to start is just to give us an anecdote of a way in which maybe you've helped people through the year with this type of planning, just to give a sense of the type of work advisors do for people with equity compensation.
Yeah, it's one of the most complicated problems that advisors have to solve for clients. And for example, there were situations in the past where a client exercises their stock options early in the year. They trigger what's called an AMT bill, or alternative minimum tax bill, let's say of $50,000. That made sense in February when they pressed the button. We were locked in on that strategy. What happens? The company struggles. They're public now. The earnings come out. The stock price tumbles. They drop 40, 50, 60%. All of a sudden, that stock is worth less than the $50,000 AMT bill that they have. And so we do year-end tax planning for those clients. We determine that it actually makes sense for them to sell the stock now, get rid of that AMT bill, and pay some ordinary income tax, as opposed to having a tax bill that's worth more than their company stock. And it's unfortunate, but I've literally seen this happen in practice, Peter. It's not fun. And that is a huge value add when you're a newly public company and your valuation isn't changing quarterly. Your valuation is changing every time the market's open, every time one of those tickers moves.
And it's a quick example of, I feel like whenever I encounter somebody with stock options, I'm typically brought into the meeting to help talk a little bit about concentration risk. And I hear our CFPs and our CPAs talk about the different tax items. And again, I can maybe repeat some like I'm in a play, but ultimately there's just so many moving parts. So tell me, John, this is sort of peak year-end tax planning time. If you decide to start December 15th, it's almost too late.
It is too late. It isn't almost too late. It's too late.
It is too late, yeah. The custodians say it's too late.
I say it's too late. Your advisor says it's too late. Yeah. Your CPA is going to say it's too late, just to be clear.
Don't call John or I on December 15th with the expectation of us doing anything. Call us, though, if you'd like to work with us long-term, obviously. But when someone shows up in October, November, they have RSUs, they have ISOs, they have ESPP. What is the order of operations here as you're trying to get your arms around somebody with different equity compensation options?
Yeah, I think that's a great question because a lot of people do punt on this until the fall, right? I had this, my income went up, I got this new equity stuff going on, my company went public earlier this year. And so they are in this spot where they've put this off and now it's the end of the year and the rubber's being there and they're like, oh crap, I don't know who's going to do my taxes and what's going to happen with everything. And so we're really trying to triage some things there because there's a limited amount of time at this point of the year, especially by the time this podcast is airing and the end of the year to get stuff done. And I'd love to say that you're going to get an entire trading plan, financial life plan, everything put together before we all break for the holidays. But let's be real here. It requires some time. And so first thing, let's get an inventory of your equity situation. Let's get an understanding of everything that's happened so far this year in particular, because that's what's going to drive tax situation this year. Then let's go a little bit deeper and understand some high-level goals. Do you plan to stay at the company a little while longer? That can impact exercise strategy. Is there anything big changing your tax situation this year versus next year? Right now, we are dealing with the fact that HR1, aka the One Big Beautiful Bill, is changing tax law between 25 and 26. And so half of those provisions coming in now, half of them coming in later. So we have this kind of external factor that's impacting equity comp planning. But ultimately, we want to understand, what have you done so far? What's the low-hanging fruit that is a no-brainer to deal with before the end of the year? And so maybe that's selling some RSUs because your tax withholding's too low. Maybe that is ISO shares that are eligible for long-term capital gains. Maybe you should enroll in your ESPP. You're in an enrollment period and you could buy your stock at a 15% discount, and we should sign up for that. It really depends on the circumstances. But I think, sometimes these podcasts sound like an advertisement for like adult diapers. Like it depends, based on your circumstances, what you're trying to do. But like ultimately, Peter, understanding what you've done so far, what you have to work with, and what is going to be changing year over year is a great starting point.
That all makes sense. There's all this time-sensitive, date-sensitive items, things that just have to be decided before December 31st. The bigger decisions, as you mentioned, around the financial plan, like how much of this stock do we want to own long-term? What documents do you need to save and get ready for the tax planning stuff? Also, so I have some options in a startup company, and it's my least favorite part of my tax return because I'm never sure if I'm doing something correctly at all. And actually exercised some ISOs and some non-qualified stock options this year for the first time in my life. And there's all this stuff I got to keep. And you walk in, I guess, help me out. So, and I'm going to be a little selfish thinking of my own situation. Like, there's RSU withholdings that I think probably a lot of listeners have. There are ISO exercises. Those things sort of trigger the AMT tax stuff. So how do you go about looking at those options so that you don't get burned by AMT in the first place?
Yeah, so let's just take a step back here. What the hell is AMT, right? Most people that are listening to this are not tax experts. They might not know what AMT is. AMT is the alternative minimum tax. It is a parallel tax system. Right? And so everybody's used to the regular tax. I've got some income, I got some deductions, or I take the standard deduction, I pay this much in taxes, right? Maybe you have a kid, you get a child tax credit, you have some dividends that show up on there, whatever. That's one tax system, fairly familiar with it. The rates go up over time. Not to give a long history on AMT, there's another system called the alternative minimum tax, which basically is a separate way to calculate your tax bill. And the old joke is like, oh, well, I'll just pay the alternative minimum tax. I don't want to pay all this regular tax, right? If there's an alternative minimum that you can pay, it sounds like a good thing. It is not, folks, okay? Let's be very clear. You don't want to pay AMT. It's a parallel system. You pay the greater of the regular tax or AMT. And so let's just kind of set that out there. You really want to work with a professional with AMT because here's why. 10, 20 years ago, a lot more people were paying AMT. 50 years ago, a lot more people were paying AMT. We've simplified the tax code. I'm going to use that in air quotes. And we made it that many fewer people are paying AMT because we got rid of a lot of deductions that were adjustments for it. But ISOs are one in particular. So ultimately, though, you're looking at it here at your end. You want to understand, how do you even figure out what's going on? You want to have records of, what did I exercise? What was the price when I exercised of the stock? What did I pay to exercise? That spread, the difference between the two, is going to help figure out if you have to pay AMT at all. And related to that, there are times when you can exercise incentive stock options and not trigger any AMT. And so that is some of the planning that you can do to say, hey, what's my break even? Where do I end up paying AMT? And then you start to set budgets to say, okay, well, I'm willing to spend $10,000 to exercise a stock, and I'm willing to spend another $20,000 in AMT. And so where does that get me from a cash flow and liquidity perspective? Because most of the time, Peter, much like you mentioned, this is private company stock. There's not a liquid market that you can sell it into and get money out of it.
And I promised myself I'd be more clear at assigning certain questions to certain types of equity compensation. But we focused, I believe, because you're the expert and I don't want to misquote, like we're focused on incentive stock options right now, where the bargain element of it is what triggers AMT. What about RSUs? I feel like I actually see RSUs more frequently with public companies. What about you?
So primarily see RSUs at public companies or companies on that trajectory. And so what we actually see in the journey of a private company is that, okay, initially your founders get restricted stock, which is different from RSUs. Then you get some options. Then these employees who are coming on, your Series C, Series D, Series E, they're starting to get RSUs because the plan is liquidity and going public. And the tax plan that we run into with RSUs a lot is less around discretion, right? With options, it's, do I want to exercise this year? How much do I want to exercise this year? RSUs you don't have control over. They vest, they're taxed then. But the big problem is that the first $1 million in RSU income that you have, and I'm hoping we have some listeners with more than $1 million in RSU income, you can come find me. The first $1 million in RSU income that you have is only withheld typically at 22% for federal tax purposes. And the fact of the matter is that most people with RSU income in the six figures are not in the 22% bracket, right? It's fairly standard. And so there's normally a big tax surprise that comes with RSUs that people overlook.
And that's so funny because when you get your bonus, typically the maximum withholding is made. And so for RSUs to have this lower withholding can be misleading. And again, it's already, I think just from watching others and again, through my own experience, it's just confusing to begin with. And so you're talking a little bit about with these two things, like you're looking at some scenarios, you're picking a path, you're trying to make taxes predictable, cash flow comfortable. What about ESPPs? So someone shows up to you, they have access to it, it's year end. What are sort of the things you're looking at?
Yeah, I mean, I think ESPPs are interesting because they're probably the most accessible form of equity compensation that we have, right? You can just sign up for it. Even if you don't have RSUs, maybe you're not in a role that has options, other types of equity, you can just buy company stock, typically at a 15% discount or so, and get some exposure there. And I think what we do with the ESPP, in part, is contingent on what the rest of your equity exposure is to the company. And so if you're at a company, you don't have options, you don't have RSUs, maybe you're early on in your career, or you're just kind of more of a rank and file employee, you're not a director, senior director in corporate executive type role, but you want to have some exposure to that company. You're working really hard. You can buy stock at a discount. You can hold on to some of it. You just want to be mindful of that relative to the rest of your investable assets. But if you are somebody, and who we typically work with is folks who have a mix of other equity compensation, and between unvested and vested equity, you just have a ton of exposure to the company. I'm a big advocate of selling those ESPP shares as soon as you can in a disqualifying disposition. Lock in that 15% discount. You're going to pay some ordinary income tax on it. Too bad, so sad. There aren't many investments where you buy at 15% discount and then can get out of it essentially right away. That's a pretty damn good deal. Just keep an eye on the plan, though, because there are some plans that have like 6-month holding periods. And if you have to already hold it for 6 months, then you might as well try to hold it for a year and get a qualifying disposition. So you have to weigh those two things.
I tend to agree with you on the selling the ESPP right away, but I'd like to dig in more on your perspective of it. Is it because you view it as, hey, this is compensation? Like because you're being paid in stock rather than cash, don't be confused, just get your cash, or is there something else there?
I think it's primarily that it is compensation. It's kind of a, dare I say, almost guaranteed rate of return in terms of that discount. I hope the compliance people don't listen. But if you thread the needle on the timing and you sell immediately, then it does kind of function that way. And yeah, I don't really think people who have close to 100% of their income tied to one company should be doubling down necessarily, especially if it's a public company, doubling down on buying more of it every 6 months.
Well, talking about the concentration in general, a lot of times employees will build up a position in one stock. It also happens to be the company that's paying their bills, like your regular paycheck. A lot of concentration of a balance sheet when you get paid in equity in some form. So how do you turn a big position into some sort of like rules-based sell plan?
Yeah, there's a few factors that come into play there. And so the first thing, like I said, let's get the inventory. Let's understand what they have. Let's understand the various tax lots. Let's understand like the mix of like RSUs that are vested. Maybe they just vested and have a very high cost basis versus options they exercised several years ago at a low price, right? Because that very different tax consequences of getting out. And ultimately, I like to start with the destination in mind. Where are we going? We ultimately want to get to a spot where maybe, let's say, 10% of your investable assets, less than 10% of your investable assets are tied up in this company stock. And today it might be 80% of your investable assets, right? You don't look at it that way because you're like, oh, I've got my 401k, my brokerage, that's diversified, and that's $200,000 that's diversified, and I have $800,000 over here of company stock. Like, you look at them as separate buckets, but when we look at it all together, it's like this is potentially the vast majority of your assets. So with that in mind, you have to go and say, okay, the real destination is 100,000, let's say, of company stock instead of 800,000. The analogy I use, Peter, it's a terrible analogy, but it's like you're standing at the steps, at the top of the steps, and you got a couple young kids, right? You've got a laundry basket in your hand. There are toys all over the steps. And like, you also got these young kids to take care of. So like, if you slip and fall with this laundry basket from the top of the stairs, it's going to be a really bad thing. And so if you have 800,000 in the company stock and your company is a target of the SEC accounting investigation, then like, we got a problem. You're going to have a much less concentration risk because the 800,000 is going to be worth 100,000 overnight and you didn't get any value out of it. So how do we get you down the steps as fast and as safely as possible? So taking that inventory, finding out how we can sell off bigger dollar amounts of shares at a smaller tax bill. I think that's a really key component of it. And so is there 400,000 of higher basis stock that we can sell right away? And then we chisel away at the other 400,000. But ultimately, agree on the destination, agree on the timeline to get there, and then find the most tax efficient way to get there that's aligned with your goals and what else is going on in your life.
I really like that. You mentioned, hey, let's maybe try to get that single stock down to 10%. But if you've worked at multiple companies and you're sitting on multiple stocks and maybe even have a portfolio of individual stocks that you've just been picking for fun, and you kind of look at it as like, well, my serious money's in my retirement plan. And then, hey, John, that's what I'm asking you to manage. But this stuff over here is just found money and fun. What do you say to that?
Yeah, I mean, I think that fun money cannot be what your retirement plan relies on, what your financial independence plan relies on. And so I talk to a ton of prospects all the time about what they're doing with their investments and how that works. And I think that ultimately, if you want to have a sandbox account where you're playing, that's great, but let's make sure that your plan isn't living and dying by that. And I don't know if you know anything about these things, Peter, but somebody who has like that mix of like company stocks, not just one, there's like this 351 exchange thing I've heard a little bit about. I don't know if...
John's poking fun at me because he knows how much I love the 351 exchange.
I was going to say, you setting me up to set you up there? I that wasn't planned, but 351 I think is probably the name of the game.
Yeah. I mean, that's definitely been a great tool. And I want to read a couple stats on just individual stock returns. And this is pretty much where I contribute to the conversation. Plain Corp is just saying like, hey, like single stocks are risky. One of my favorite papers that has come out in the last several years is from Hendrik Bessenbinder. I think he goes by Harry though. Not that we know each other personally, but I don't know how you get to Harry from Hendrik is all I'm saying, but I'm pretty sure he goes by Harry. He looked at the total returns of U.S. common stocks from 1926 through 2016. So this is not through present, but certainly a long period. So the median stock generated a return of negative 3.66% per year. Only 42.6% of individual stocks had lifetime returns that exceeded that of 1-month treasury bills, which is sort of a proxy for cash. So over 40% of stocks are going to lose to cash. But here's the big one. There are nearly 26,000 stocks that have traded in the U.S. publicly.
Over the course of history, you're
saying?
Over
the whole period, since 1926. The top 4% of the stocks accounted for all of the net worth creation going back to 1926. And of those top 4%, only 90 companies out of the 26,000 accounted for more than half of that. Now, there's all this stuff about how there's permanent losses in individual stocks, but I mean, like, I operate from a place in building portfolios of probability and like base rates and such. And I think what's really important in these conversations, if you're listening to us still, it means you must have equity compensation because we've already gone down the rabbit hole. Sometimes the hard part is people see what was said at Investor Day, or they're an executive themselves and feel like they have control over the price. And I think you just have to remember that it is not a 50-50 shot at beating the market. I think sometimes even when people see an individual stock go up, they assume, oh yeah, I won. It's like, well, the opportunity cost was the market. So that's the only place I can contribute to this conversation, John. So I appreciate getting to read some stats. But yeah, I mean, like you have to have a plan and you want to be tax efficient. But at the end of the day, if it plays out like the averages, the taxes are the least of your problems.
Correct. Yeah. If it plays out like the average, you're screwed is basically what your data set said, right? Technical term, but.
Yeah. So let me pivot a little bit because the diversification piece I feel strongly about. There is a strategy, I think it's just for executives, called a 10b5-1. I dare anybody listening to repeat the letters and numbers I just said in the correct order. I know that to be an important strategy for a certain type of employee. Tell me what you know about that.
Yeah. So a 10b5-1 plan is essentially a predetermined selling plan that you enter into with kind of your company and the brokerage firm that oversees the company stock plan that says, on these dates at these times, I will sell this number of shares. I'm signing a contract based on that, and I don't have discretion over it anymore. So once I agree to this, it's going to happen. They are fantastic tools to take the emotion out of selling your concentrated stock. They are also really nice tools to allow you to sell shares at other times of the year beyond when you're just in a trading window. So the wonderful thing about a 10b5-1 is that as long as you enter into it in an open trading window, and there's some sort of cooling off period between when you set it up and when the trades start to take off, you can often sell outside that window. So maybe you're selling monthly instead of quarterly. You can also get really creative with them sometimes to say, hey, I have and I don't encourage, I'm a big advocate of we're selling every quarter, whatever the hell the price is. If the price is really high and you want to sell more power to you. But there are ways, sometimes, for example, the company stock is much higher when you're not in a trading window than it is when you are, especially there's a lot of employee share transactions happening. And so with the 10b5-1, you can say, okay, well, if the price hits $150 a share, regardless of when it happens, as long as it's during this plan, I would like to sell 50% of my shares. And if that doesn't happen, I'm selling 10% a month for the next 10 months. So those are some of the ways that they can be leveraged. And I think the biggest benefit, though, is a behavioral finance element. Let's take the emotion out of this and I need to log in. Oh, do we still want to do that much? Oh, the earnings could have been better. The market didn't react. We beat on our EPS, but the market still sold off because of our guidance. Don't get caught up in all that crap. It's out of your control.
Well, that's, I think, why I like them. And I mean, am I wrong? Are they not available to anybody? Do you have to be at a certain level of employee to have access?
It depends on the company. And so if you work at a Google, one of the big tech companies, a lot of times, and their vesting is typically monthly at Google, a lot of times rank and file folks can set up a predetermined trading plan. It's not going to be as sexy, perhaps, as some of the 10b5-1 characteristics I just talked about. But most other companies that are not huge Mag 7 big tech, you have to be at a certain level on kind of the org chart, basically, to be eligible for it. And it's really for those people, Peter, to be clear, that in a normal trading window might still have some sort of inside information. Because if you're the CEO of a company, CFO, high-level director, you know of this M&A thing that could be happening 3 quarters from now. You know about this new tool that you thought was going to be great that has all the CapEx, but is really struggling. And you always have some sort of inside information.
Yeah, that makes sense. And so we're talking a lot about divesting of our concentration, selling. The other thing that we see at year end is charitable gifting. Not everybody's charitably inclined. Donor advised funds, when we go back to the Tax Cuts and Jobs Act of 2017, donor advised funds and bunching gifts was a go-to strategy. The One Big Beautiful Bill Act changed a lot of that, I think. Again, you're the expert. So tell me, when someone comes to you, they say they're charitably inclined, you're excited to help them divest of concentration risk. Are you looking to donor advised funds? Are you looking at other strategies? What's that conversation like?
We're definitely looking at donor advised funds. We're definitely looking at them in 2025. And that's because HR 1 Big Beautiful Bill puts a new charitable threshold in place for 2026, which is 0.5% of AGI floor on any charitable gifts that you make. And to put that in more layman's terms, let's say you have $1 million in income, to keep it really simple. 0.5% of your AGI would be $5,000. And so the first $5,000 you give to charity would not yield any tax benefit starting in 2026. This year, if you are itemizing, every dollar you give to charity will yield some sort of tax benefit. And so there's some very interesting strategy around loading up a donor advised fund with several years worth of contributions in 2025 to get probably the biggest write-off and then dole that out to charities over time. And it's interesting. It's actually kind of counterintuitive, Peter, because the historical tax planning, when you and I were going through CFP coursework many years ago, it was you should pair your big charitable gifting years with your big income years. that might not actually make sense because of this phase out. The phase out scales with income. And so 2025 is probably the year to load up on a donor advised fund. I honestly think that this provision of, not to really prognosticate here, but this provision of big, beautiful bill is probably not going to be very popular with very big donations, charities, that sort of thing. I wouldn't be surprised if Congress comes back at some point, looks at this and says, what were we really trying to achieve? We're going to adjust this, but I wouldn't count on it.
Well, I will admit that I'm interested to see how those conversations go, just knowing that like the way that we've been bunching gifts might change a little bit. And if you have company stock, I mean, really the only way to get rid of taxes in general is to give money away in some capacity. And if you're not charitably inclined, this doesn't have to be necessarily the preferred way. I guess the other conversation that comes up often is like family gifting. So any thoughts around that as it pertains, whether it's broadly or to equity compensation folks specifically?
Yeah, it depends on your goal. I mean, I do get the questions around like, should I give to my young minor children, put some money in an UGMA, they can have 0% cap gains tax, very low. It's like you hit the kiddie tax thresholds pretty quick. It's like $2,500 in income. So like, is the juice worth the squeeze is really the question. I think the gifting of appreciated stock to other family members is a nice play, but it depends on what your position is. If you are the matriarch of a family and you have very low basis, what's the utility company out there in St. Louis?
Ameren. Ameren's the publicly traded utility area.
So you've like old Ameren stock from days gone by that you've held on to, like the dividend. Your cost basis is very low. And you're like, oh, I might gift this to my grandson. If you are 95 years old, you might say, well, you're better off holding it because you get a step up in basis to date of death, not to be morbid with it. But, the gifting logic is less these days about estate tax because the estate tax threshold for a married couple is $30 million. It's kind of hard to hit for most folks. So definitely think gifting, definitely think about gifting appreciated securities to charities, definitely think about it within the family, but gotta take a deeper dive on what makes the most sense in neutralizing a tax bill over generations.
So when I think, again, I'm trying to stay on the theme of things that are coming up on year-end tax planning conversations, particularly like when a new client comes in, because sometimes when there's an existing client, they sort of know what the program is. They know what to keep, what to send us, like when to reach out, when we'll be reaching out proactively. When somebody reaches out to you for the first time, what are the documents that you find that people have not remembered to keep track of or don't know what they're talking about? Like, what should people be keeping their eye out for or going and downloading and saving now?
Yeah, so any confirmations of exercises that they've done with options, and especially if it's at a private company, sometimes those confirmations are in paper form, sometimes they're written in ink, sometimes they're not very well kept. It's gotten better over the years, but we've seen some of them that look like they should have been written in crayon, frankly. But you want to keep a year-end pay stub. It's really nice to have a pay stub to reconcile with your W-2 if there's equity activity, because sometimes those numbers on the W-2 don't tell the whole story. And so that's a big add to have on hand. Get your account statements from throughout the year, track those. And so we have a specific checklist basically that we give clients that we're preparing taxes for that lists out all the things that we need, because it can be a bit of a quagmire. And tax reporting on equity compensation in general is a bit of a quagmire. And we found mistakes, that companies have made over time because of poor record keeping, complexity of equity comp. There's now not only your payroll provider, but your custodian and your HR team and your finance team that are all involved, and everybody needs to do their job right in order for it to end up right on your tax return.
Well, so let me ask the $1 million question, or maybe it's the $10 million question or $50 million question. At what point for somebody who has equity compensation, realistically, do they need to start considering getting professional help?
Yeah, that's a great question. I got to answer to a different question, which is like, what is the intersection where I normally meet people at and have an initial conversation? It's normally where, hey, the numbers are getting bigger, the complexity is getting bigger, and you're at a point in life where it's like, hey, I don't think I have the time and the bandwidth to figure this all out on my own. And there are these unknown unknowns that are floating around with all this. And so it's a qualitative place in life. And it's also a quantitative place for like, hey, I can afford to finally make this investment in myself as well and get the professional help that I can use to navigate all this.
Yeah, that makes sense. I was talking to some college seniors earlier this week, and some have equity compensation. They asked me that question. And I was like, you guys don't really need advisors yet. Like, wait till you're maxing out all your retirement plans and you have taxable savings. So like, but how do we do this? Like, well, you can work with a tax professional. But I do think The reason I mention that is I like what you said. When you can afford it is the time that makes sense. There's nothing cheap about financial advice. And I feel like sometimes people are angry that it's not cheaper, but it's complicated. And the costs and the compounding of those costs are very, very large. I think that's the piece that most people miss is it's not just the mistake cost saved, it's the compounding of it all that can be really impactful.
And I think, what's the difference? You have some equity comp, you have these transactions. Hey, do I need to hire a financial advisor that does this and incorporates tax? Or should I just go, hey, my uncle's a CPA in Toledo, should I just have him do the return? And it's these are such niche issues with niche complexity and surprises that oftentimes, if you just take a CPA, here's my stack of documents I got in the mail that says important tax stuff, file my tax return, and they're not experts in it, they're not going to know to ask the questions hey, this looks off. Hey, your cost basis says 0. Is that right? You did exercise ISOs? We need to look for AMT. So just be careful with that. Sometimes the lowest cost thing is the lowest cost for a reason, or you're not getting the expertise that you need.
All right, I want to land the plane with the biggest mistakes and putting you a little bit on the spot. What are the big things that you see people making mistakes on in this space?
I think poorly timed incentive stock option exercises. You really don't want to exercise incentive stock options very late in the year because there's a holding period requirement to sell incentive stock options for long-term capital gain. It is 1 year and 1 day from exercise. And when you're working at a company, you have these blackout windows. And so your trading window might close November 15th and you can't sell again until February. And so if you're exercising in December, you are artificially creating a 2-year holding window because you won't be able to sell till February of the following year, right? 18 months later or so. So that's one thing I see. Folks who just assume that the withholding on their RSUs is accurate. And so, hey, they take taxes out, everything's gonna be fine. And then they get walloped with a big tax bill. And then honestly, I think the biggest mistake I see is drinking a little too much of the company Kool-Aid, riding the roller coaster a little too long, and not taking a break every once in a while, taking some chips off the table, because that can ultimately cause the biggest amount of financial damage.
Yeah, that last one I see all the time. So important to have a plan because you start anchoring to funny prices that you missed out on or that you think are going to be there. And the emotional roller coaster reminds me of people who go to cash and they don't know when to get back in. It's a similar sort of emotional torture. John, this has been super helpful. Where can people find more information about you and the firm?
Yeah, brooklynfi.com. We're also on Instagram, LinkedIn. John at brooklynfi.com. If you have any questions, always happy to help. Peter, lovely to be on the podcast. If you can't tell, I could have talked about this for 5 more hours at least, no problem.
Yeah, I feel like at some point in time, I have to have a deep dive series where we go into one different type of equity comp each time. For listeners still with us, we appreciate you. What I've learned about the topic is it's wide ranging. And so how about this, dear listener, if you're watching us on Cheddar or on YouTube, go to the podcast, review it, tell us what you want to hear about. I'll have John back. I'll have John or any of his partners or any member of my team back. We'll talk about whatever you guys want. Be sure to go to thelongterminvestor.com where I'll link to John's information, where you'll have very detailed show notes and some action items from today's conversation. But other than that, John, appreciate you taking some time out of your busy day to talk to us all.
Thanks for having me, Peter.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.